Welcome to The Explainer. Today we're looking at a company called Vinyas EMS. And let me tell you, it's a fascinating case study. It's really the perfect example of a classic battle on the street. You've got this incredible, explosive growth story on one side, and on the other, you have sky-high expectations and some very real risks. So which is it? Is this an emerging champion, or is it a bubble just waiting to pop?
And that really gets to the heart of what we're talking about today. What exactly makes a company a true emerging champion? We're going to use Vinyas EMS as our guide here to really unpack the ingredients for that kind of massive growth, but also to shine a light on the hidden dangers. And, look at the tough calls investors have to make along the way.
All right, so first things first. Who is Vinyas EMS? Let's dive in and get to know the business and the pretty specialized world that it operates in.
Okay, so Vinyas is in what's called the Electronic Manufacturing Services sector, or EMS for short. Now, what does that mean? Well, think of them as the master builders, the expert hands that assemble all the complex electronics that go inside products for other huge brands. It is a booming industry because, let's face it, more and more companies are choosing to outsource this kind of supercritical specialized work.
Now here's what really makes Vinyas stand out. Its intense focus. A whopping 78% of their entire business comes from just one area, defense and aerospace. I mean, we are not talking about building your next smartphone here. This is a super specialized niche, built on long-term, high-stakes contracts where there are way fewer competitors.
So you might be wondering, how do they lock in that kind of business? Well, they do it with what's called an end-to-end service model. They handle literally everything, from the initial design all the way to aftermarket support. This makes them incredibly sticky for their clients. It's not just a simple contract. It becomes this deep, integrated, long-lasting partnership.
Okay, so now that we know who they are and what they do, let's get to the really exciting part, the bull case. This is the argument for why Vinyas might just be strapped to a rocket, ready for takeoff.
The whole argument for this company, the entire bull case, really boils down to one incredibly powerful idea: visibility. The optimism here isn't based on some vague hope or a guess about the future. No, it's built on a rock-solid foundation of confirmed, locked-in orders that they already have in the bag.
And here is the number that has everyone paying attention, an order book of over 1,000 crore rupees. Just to be clear, this is the total value of contracts they have already signed and are scheduled to deliver over the next few years. It's already on the books. Now, to really put that number into perspective, check this out. Their current order book is 2.6 times their entire projected revenue for this fiscal year. Think about that. That means they already have nearly 3 years of work lined up and confirmed. That gives them an incredible, almost unheard-of level of visibility into their future earnings.
And this isn't some brand new thing for them. If you look back, you can see this really consistent history of powerful growth. I mean, sales grew at a very strong 23% a year, but look at their net profit. An absolutely astonishing 85% compound annual growth rate. That shows you they're not just getting bigger, they're getting way more efficient and profitable as they scale.
And finally, the bulls will point to their competitive moat. And these aren't just, fancy quality certificates. These are deep regulatory barriers to entry. Getting approvals like NADCAP or being approved to manufacture for the US government, that stuff takes years and a ton of effort. It makes it extremely difficult for any new competitor to just show up and play in their sandbox.
But, it's not all clear skies. Every strong bull argument has a counterpoint. So now, let's flip the coin and look at the bear case. All the reasons you might want to be a little cautious here.
And the very first thing that jumps out to any skeptic is the price tag. The company is trading at a price-to-earnings ratio of nearly 79. Now, in Wall Street terms, that is what you call a rich valuation. It means the market has already priced in a massive amount of future growth. The expectations are incredibly high.
And that high price comes with some very real underlying risks. For one, their heavy reliance on defense makes them pretty vulnerable to any shifts in government policy. And yeah, having a huge order book is great, but now you have to actually execute on it perfectly. On top of that, a low promoter stake can sometimes be a governance concern, and because it's listed on the SME platform, the stock price itself can be extremely volatile.
So there you have it. You've got the bull case, which is all about visible growth and a strong protective moat. And then you have the bear case, which is worried about that high valuation and concentration risk. Let's put them head to head. And here, this is where the whole story really comes into focus. Just look at this for a second. Notice how each strength is almost a perfect mirror image of a concern. That niche defense focus that gives them their moat, well, that is the concentration risk. That incredible order book that gives them visibility, that's what's fueling this super high valuation. This right here is the central tension of this whole story.
Okay, we have seen both sides of the coin, we've heard the arguments, so after weighing all this evidence, what's the final takeaway from the source analysis? Where does all this leave us?
Well, the verdict is pretty clear. This is a classic high-risk, high-reward play. If, and it's a big if Vinyas can execute on those orders and keep their profitability up, the analysis sees a potential for the stock to double or maybe even triple over the next 3 to 5 years. But that if is doing a lot of heavy lifting in that sentence. This is a long-term play, and it's definitely for investors who can stomach the ride.
And that kind of leaves us with this final thought to chew on. When you're out there looking for that next emerging champion, is the very presence of significant risk just part of the deal? You have to wonder, maybe the only way to get that potential for an outsized reward is when the outcome isn't a sure thing. Something to think about. Thanks for joining The Explainer.